Welcome back, everyone, to the 5ers Live Trading Room and the Bootcamp Trading Week. I'm super excited to have you all back. Hope you guys had a really good educational session before this one where I talked about the difference between swing trading and day trading. Today, we're going to be hearing from Victor, our in-house expert for risk management. How's it going, Victor? Welcome.
How are you doing, Jonathan? And how is everyone at home? I hope you guys are excited as I am, because this is important, guys. If you want to be a
Yeah.
great trader, want to be have success, you have to be able to master these subjects, and we are offering them to you on a silver platter for you to indulge, improve yourself, and become that person you aim to be. So I'm very excited, guys. I'm excited for the fact that the traders, they have a great opportunity here. This is unique in every sense, where you are offered the education, the knowledge, and also right away a boot camp account that you can, if you apply these concepts, these ideas, these lessons properly, you will have a great chance in getting funded, and yes, getting real money in your pocket.
How many firms are doing this? Like how many firms are doing this? The hours of free education here is just insane. Just it's crazy. So guys, like the replays are going to be available. You're going to be able to watch this. Of course, in the live, you get the chance to ask questions, but you can learn at your own pace as well. And there's hours and hours and hours of content spanning from fundamental analysis to technical analysis to risk management that we're going to talk about today, and then trading psychology as well. So very, very excited to be able to be part of this program and really impact people and really help people in a truly meaningful way. And that's what the 5ers is all about. It's about empowering traders with knowledge that we're going to be talking about today. And I've also talked to the team. I said, you know what? I'm getting a lot of messages. I'm getting a lot of emails, a lot of comments saying that, I didn't have the time. I didn't have the time to sign up. Can we please extend the sign up time? So yes, that's what we did. You can still sign up for the event. At the very first sentence of the description of this video, you will find a link to sign up to the Bootcamp Trading Week. It's not too late. You can still go and watch the replay from yesterday. You can still submit the assignment from yesterday. We're going to have a new assignment for this risk management session as well. And before I give it over to Victor, I want you guys to really pay attention here, okay? Because even though all the sessions for this week is important, I mean, we're talking about technical analysis, we're talking about risk management, and of course, tomorrow we're going to talk about trading psychology, and that's also super important. But the thing is, here at the 5ers, we see traders come and go, and we see some traders that stay long term, and they stay long term not because they have a super profitable strategy. They stay because they have a good understanding of risk management. The reality is that you can become a profitable trader with a decent trading system, but if you have a good risk management system, you're never going to be profitable with a very good trading system but bad risk management. So this webinar today, if you incorporate the things that Victor is going to teach you today, you're going to have the opportunity to stay in the market for as long as you need to become profitable, because that's the problem that a lot of people do. They come into trading and they lose the accounts, they lose the capital before they reach profitability. And without the capital, without the money, it's impossible for you to trade. So this right here today, super important. And of course, if you do have any questions, please feel free to ask them in the comments. I'm going to be in the background. I'm going to be starring some comments. I'm going to pull them up on screen when there's time to do so. And we're of course going to go through every detail that you need to know about the assignments, and we're going to go through every questions that you need so that no questions today goes unanswered. Victor, I'm just going to leave it. I'm just going to leave it to you. Do your thing. We got a very exciting, I guess, an hour and a half, I believe, in front of us.
Something like that. Yes, it can vary depending on the flow, of course. But yes, it will be an hour and a half, maybe a little longer, maybe a little shorter, probably a little longer, but an hour and a half around, give or take. a few
And
minutes.
if we do have the time, after, we're just going to look at a couple of levels because we do know that there's something going on in another country in the world, which is quite a big event. So we want to look at a few levels on perhaps the bigger forex pairs if we do have the time, and just give you some directions that we might think, give you a couple of ideas for that. But that's going to be after the webinar if there's time to do so, and after the Q&A session. All right, Victor, it's the stage is yours.
Thank you, Jonathan. Let's see. We have this presentation. Will be the following presentation for our Bootcamp Trading Week. Let's get started. I will get my screens in order. All right, so I'm going to be talking about risk management, of course, and we selected some very important concepts for you to manage risk properly, right? So key concepts for optimizing your risk. For those who don't know me, my name is Victor, also known as the Masked Trader. I'm a funded trader at The5ers. Let's get going. So what will we cover in this presentation? Well, I'll talk a little bit in general of my ideas of risk management, how I see it. Of course, we will be talking about position sizing, since that is one of the important basic, very important ways to manage your risk. We'll also introduce the concept of R for everyone who's not familiar with it yet. And also I will discuss something very, very important. I believe this doesn't get enough attention in the prop firm industry, especially, but in trading in general, which is the available risk capital, right? And we will then get to the best part, I think, which is the optimal risk strategy. I'll be talking about it in detail, and it's the fixed fractional risk. And I'll tell you all about it in our presentation. So let's continue. So let's start with risk management, right? Why these strategies matter? Well, first off, if you think about it, if you want to be a successful trader, you have to manage three things in general, right? Three things. If you miss one of them, I call them, they're called three pillars in trading for a reason, right? If you miss one of them, you will not succeed in trading. So very important that you're able to have all three of them in place and properly manage. One, of course, is the technical edge, your strategy, right? If you don't have a profitable system, it doesn't matter anything else you do, you will not be profitable, right? So first thing, of course, is your strategy. It needs to be profitable, and you need to have an edge. Second, I will skip, but I'll go to the third one, which is your psychology, right? Your mindset, your ability to follow the plan and to be able to withstand setbacks, etc., right? Very important. If you don't have that in place, you will not be able to succeed as a trader either. And the one I skipped is, of course, risk management, right? You can have the best trading strategy in the world, combined with the best psychology, the best mindset, but if you don't manage risk, in the end, you will still fail, right? So it's very, very fundamental we understand this, that risk management is essential for your trading career, okay? The other thing I would like to say is the following. Risk management is why it is important. Of course, when you come to the market as an aspiring trader, you typically think about the profits, right? You think about what you're able to gain, the potentials, right? If I manage this account, I will be able to get this kind of money in the future, right? Well, that is good, but if you have, after some time in the market as a trader, you probably came to the conclusion, or will come to the conclusion, that prioritizing profits is not the best thing. It is much better to prioritize the risk, because one of the first rule in trading, in investing in general, but in trading, is capital preservation, right? And so it is much more important that you prioritize risk above profits, because that will keep you in the game, as Jonathan just said there, which, because if you don't, it doesn't matter how many profits, how much profits you may have earned in your career, in your week, in your month, in your year, or even years. If you don't have a proper risk management in place, what will happen is you will lose it all sooner or later. So it's very important that we focus and prioritize risk before profits, right? In other words, survival before profits, right? All right, let's continue. So what is risk management? If I ask you what comes to mind when you think about risk management, what would you say? You can put it in the chat. Um, and we all will be able to see that. Most people would say uh, position sizing. And yes, position sizing is very important, because that is, the probably the most important thing that you can do to manage your risk. That is important. However, I would like to think for a minute, or stimulate that idea that risk management is, of course, much more than just your position sizing. In essence, it is anything that threatens the survival of the account, right? Not just position sizing. Position sizing is a risk that comes, right, that you manage, that is inherent to the strategy, right? Depending on the strategy, you will have different drawdowns profile, right? And depending on that drawdown, of course, you should be basing your position sizing. We'll get more into that later on. But the position sizing is something specific to the strategy, right? However, there are more risks to be considered. Another one is the one I would like to call, put in the group, execution risk, right? It is anything that will impede you from adhering or sticking to the strategy, right? If there, let's say your strategy is on a very low time frame, like on the 1 minute, uh, for you to execute that strategy, you need to be focused and ready at that moment, right? If it is, let's say, your trade plan tells you to enter the trade at the close of the 1 minute, it means that you need to be ready and able to be there, to pressing the buttons, because if you don't, you of course will not be able to trade as the strategy, as your trade plan tells you. You probably will not be able to extract the edge that you have, confirmed in your back testing and you expect to get in the future, right? So that's a risk. That's a risk to your performance. The same way, emotions. If you are unable to handle your emotions properly, and let's say you had a loss, and at the second after that loss, you, by not being able to handle your emotion properly, you start taking another trade which is not part of the plan. That's a risk. That is probably, that trade will not have the same profitability as the one that you were supposed to take, the actual signal, right? So it is a risk to your performance and to your account in general, in the long run. Another one is human error. Imagine if you're putting in your lot size and you put an extra digit, right? Instead of one lot, you put on 10 lot. That's a risk, of course. I don't need to explain that, right? That is a huge risk. All of these things you as the trader need to manage, right? As a trader, you are, I think, first and foremost, a risk manager, right? So you need to be aware and have strategies and measures in place to avoid these risks, right? Because you need to keep and protect the account. That is your job. All right. So besides the execution risk, you also have external risks that are not specific to the strategy and not specific to you executing the trade plan, right? They are, for example, high impact events like today, right? We have the US election going on. These high impact events can cause slippage, right? Especially like NFP that comes at a specific time, a specific second. When these events happen, the market has different ways orders get filled, right? So, for example, you may put your stop loss at a certain level, but if NFP, for example, were to occur and your, at NFP price can gap up or down many tens, 20, 30 sometimes, depending on the pair of pips, right? And if your stop loss is in between, that means that your stop loss will not get, your trade will not get filled at that desired level, right? And that is called slippage, right? You will get filled at the next available level, which may be a long way further down or up than the level that you set in, meaning that if you were, let's say you were risking 1,000, you may end up losing not 1,000, but maybe two, three, or maybe even more, right? That's a huge risk. That also needs to be considered as a trader. What is the impact? What is the risk of high impact news on my strategy? And lastly, you also have infrastructure risk. And by that, I mean, of course, the risk of power outages or perhaps have difficulties with your internet connectivity. Of course, the power outages for many Western countries is not very frequent. But for other countries, this may be an issue that you need to consider, right? Have a backup plan in the case, right? In the case of internet connectivity, if your Wi-Fi router or internet server provider has a failure, what are you going to do? Let's say you put on a position, but you haven't got to put on the stop loss yet. That is a huge risk, right? So one of the things you could do is have the MT5 app on your phone, just in case, as a plan B, if you indeed have no connection or perhaps your PC has some issues. You can, within a couple of seconds, basically have access to your trade, right? These things, I know they are the infrastructure risk is a low probability risk, doesn't happen that often, but as a risk manager, you need to have at least thought about these things, these risks, and have a proactive plan about them, right? If it happens, you have a contingency plan that you can go to, right, before in advance. All right, so that's a little overview of the different kind of risk we can have in trading. Let's get to the position sizing. So what is position sizing? For perhaps we have many experienced traders in the audience, but it is good we go through them, from the very first level, like entry level. What is position sizing? Of course, position sizing is the amount of capital that is allocated to each trade, right? That is how much you're risking per trade, right? And there's much to be said about this. One of the things that I want to say is if the trade, right, if the trade is the same trade, the setup is the same strategy, and it's based on the same data, then that setup should have the same risk, right? Unless you have more data that tells you that, a particular setup is more profitable than other, right? Let's say you have A and B, and A you have is much more profitable, then in that case, you could argue A should be allocated more risk. But if that's not the case, every trade, every setup should assume the same, have the same risk, right? Allocated the same risk. This is the formula for your position sizing to calculate how much the size should be of your position. The the lot size, right, is the risk capital, times the risk, and in risk in this case would be like 1%, 5%, whatever a percentage you're risking, that divided by the pip value, right? So what is the value of 1 pip per full lot? Okay, times the number of pips to your stop loss, which is from the distance from your entry to your stop loss. Okay, if it seems like a little bit difficult, a little bit complicated, don't worry, I will come back to this and explain it in a little bit more detail. All right, so that is the how you calculate how big that position should be. Now let's have an example to make it more clear, right? Imagine you have a risk capital of 10,000 and you're willing, or you agree, your trade plan tells you to risk 1%. And let's assume that the pair to be traded is euro dollar, and also that the distance from the entry to your stop loss is 20 pips, right? Let's put that all in the formula. So you have, right, you have 10,000 times 0.01, which is 1%. If you, let's get back to the original formula. This is it. So it's risk capital times risk, right? That's what we have here. The risk capital being 10K, $10,000 times 0.01, which is, of course, 1%. That gives you 100. Okay. And what is below, if we go back to the original, is the pip value per lot. So how much is 1 pip cost per lot times the number of pips to stop loss. So we go back. That is $10 because we're trading euro dollar. If you open a 1 lot position on euro dollar, each pip it has a value of $10, right? So that's the pip value per full lot, right? Which is $10 times the number of pips from entry to your stop loss, which is 20 in this case. You multiply those two numbers, you get 200, right? You divide that 100 according to the formula by 200 and you get 0.5, or in lot number 0.50, right? So that is the size to be taken if you want to be risking 1% of your risk capital, right? Which is $100. So this is how you do it. This is the manual way of doing it. And of course, you have different ways to calculate this. Manually, as we just seen, you also have web calculators that can help you do this, right? There are many web calculators out there where you can use. I only have this. I've put on this one because it's very popular. You can, for example, look at myfxbook.com where you'll find forex calculators to help you calculate the position size. And also there are tools that can be used in on your terminal, right? On your MT5. And these can be indicators or EA that will help you calculate position size very quickly. Well, other than that, one of the one we recommend is position sizer from earnforex.com, right? I think it's one of the greatest tools to help you manage your risk through your position sizing. So I firmly recommend this. Previously, it was an indicator called Position Size Calculator, PSC, but since a couple of months, it is now an EA, which is, of course, by the name of Position Sizer. All right, let's look. I will switch my screen for a little bit to show you guys how that works. Let me get this going. Yes. Okay. And I'll bring back the image. Yes, this is my FX book, as you can see in the address bar. This is my FX, and if you go very quickly, just look, it has FX tools. If you go to the FX calculator, you will find different calculators, and of course, what we need is the calculator, the web-based one, right? So here you find the currency pair, and you put in your currency of the account, the currency pair that is going to be traded, and also the account size, the risk capital. In our case, it was 10,000, and the risk ratio. So how much you're going to be risking of that risk capital, how much, right? How many percentage you're going to be risking of that risk capital, and the number of pips to your stop loss from your entry, right? The same things we just input manually in the formula. And trade size in this case is it is one if your broker, if one lot is 100,000 units of the currency, which is the case in most brokers, including the 5ers. The 5er isn't a broker, but I mean, with a prop firm, on our server, this needs to be one as well. And you click on calculate, of course, and it'll give you the risk that you're taking per trade, the units, how many you need to be opening, and this is what you actually need, which is the position size, which is 0.5 lots, right? So this is how you calculate this is how you use the web-based calculator. And I will switch back to, let's see, I will switch back to another screen to illustrate. Let's get this to illustrate how to use the other tools that we talked about, right? So that is that account. Yes. So yes. All right. This is my funded account at the 5ers, one of my funded accounts. Here you can see I have already downloaded and installed the position sizer from earnforex.com. Of course, you'll have to follow the instructions if you don't have it yet, and to put it in the proper folder. There's instructions there which will help you do that. But once you have that, you will have to drag the EA onto your chart, and you will see this window, right? So, and this is, I recommend, it's good to have the knowledge to do the position size calculation manually, but it's better if you have I recommend having this position sizer on, because it's very efficient, very quick, and you minimize the chance of making an error. So let's quickly go how to use it. What we have here is, you have, first thing you have to choose, we have a couple of tabs in here on the trading on the EA, on the user interface. The first one, you have to choose where the direction of your trade, of course, if it's a long or a short, and there is a space where you can put in the stop loss. Either you can do that manually, like so, 1.08. Let's say we want to have our stop loss below this swing low. Let's say that's 72.3, and I want to put it at 70.1. Imagine that is the case, right? I click on that, click on enter, and as you can see, the stop loss already goes there. There goes a red line there, horizontal line, and that's the stop loss line. Also, you can also notice there is another, a green one. Well, the colors, you can set them yourself. By default, they're not these colors. I have these on. What you can see is this is the profit line, and that the stop line. You can also put it in as manually, as I just did with the stop loss. However, besides that, you can also use, just visually put the horizontal line at the desired level, right? Let me get this a little out of the way. Let's say you want to target the top of this swing high. Imagine that, right? If that is the case, then automatically you can see that the level is 0914.6, and that's the same take profit. And if I move this, you can see how it adjusts automatically. Very, very practical to do so. Okay, let's continue. So you put in your stop loss and your take profit. and afterwards you put you can there is a space for your commission. If you don't know what the commission is of your the pair that you're trading, you click, of course, on the market watch, right click it, and there's that specification menu. You open that up and you look for commission, right? It gives us here $4 per full lot, right? That $4 right here is, of course, opening and closing the position. And the EA is asking us for the one-way commission, right? So not just the half of opening and closing, right? So just opening, and that in that case is $2. After that, you have a place to put in the balance, the capital. It says account balance, but it's more, I would like to say, risk capital, and I'll explain to you later why I make that distinction. And this is the part where you set your risk. You can say, for example, you can put in, I want to risk of my risk capital, 13,500. I'm going to risking 1% of that that amount, right? If I put that in, you put in enter, below you'll find the position size. And that position size in this case is 0.55. Hold on, 0.55. And the what else? Let's see. We have that is the size of the position to be entered right there. Let's see. What else do we have here? What you also have is that's the, if you put in the percentage, but you can also put the dollar amount, right? So let's say you're risking a fixed amount, dollar amount, which is let's say $100. You put in 100, and then hold on, Jonathan, could you take? I'll need to take a little break, maybe 2 minutes, before continuing to the presentation.
All good. Yeah, all good.
Hold on,
All
I'll be
good.
right back.
Yeah, no problem. All right, let's see. What are we gonna do now? Victor's gone. No idea what we're gonna do. Let's do something fun. Let's take a look at. Well, let's remove that one. This happens all the time because Victor is usually getting a lot of calls from the market makers saying like, your stop loss is a little bit too tight. We're gonna take you out. We're gonna get that stop loss. He's the definition of being hunted by the market makers. Okay, here we are. Risk management, pause is the word. Got the US elections today. Insane price action. Victor's going to be back any moment, and I want to show you something cool. Hopefully before he gets back. If you guys are looking for going long on like Bitcoin, look at this. We have a beautiful retest of what I like to call the reload zone right here. And you know what I want to show you? You guys remember yesterday's webinar where I talked about the fundamentals of the technical analysis? I think I got some pretty cool examples for you guys here. Remember how we talked about, we talked about how the market is fractal, and we have one big move here on Euro USD to the downside, right? And if we zoom in on that down move on the daily, we're obviously going to see a pretty nice downtrend here in the 4 hour. And what happens here at the bottom? This is just picture perfect, right? It's picture perfect. Come down here, like that. So nice. And then we have like a range forming here. We're going to break out, and then it forms an uptrend. This is just a picture perfect market structure, right? Almost like Mr. Charles Dow just came back and said, let's print the picture perfect Dow theory market structure on Euro USD. You know something else that has a picture perfect market structure? That is AUD USD. Look at that. Perfect. Absolutely perfect. Very similar move to what we had on EURUSD, right? Broke a level right here. Big move to the downside. You can look at the daily, get a big, nice move to the downside here on the daily, hit a very cool support down here, formed a bullish market structure here on support, breakup structure. So yeah, we're getting a lot of questions on in the comments as well on yesterday's assignment. Man, I feel like this camera angle is just a bit too tight here. Let's switch to perhaps this one. Oh, look at that. Not much better. I'm going to go back to this one. Take a step back so you can all get a good look of me. Okay, so we have a lot of questions in the comments, and of course, if you do have any more questions on risk management or this event in general or anything that we covered this week, please let us know in the comments, and we'll do our best to help you out. So the assignment yesterday, okay? I know that a lot of people, you're uploading the assignment and it says awaiting moderation. That's not a problem. It means that you did everything right. You just move on, let it, move on to the next assignment, which is the assignment today. And before you continue, Victor, I just want to talk about the assignment. So the assignment today is that for all of the trades that you're going to take following this webinar, it has to be 0.25%. And there's more information on the assignment on the event page. So make sure that you go to the event page, scroll down. There's going to be all the information that you need on the assignment. And you're also going to have links to the MetaTrader EA that Victor mentioned as well. Okay, so I'm just going to run away and I'm going to sit in the corner again of the office and wait for you to finish your presentation, Victor.
Yes, my apologies. I had a little family emergency I had to take care of. These things happen. All right, since that happens when you're, doing things live. But let's get to the topic at hand. I was where we left off was where you can put in your risk, right? The percentage you risk from the capital, the risk capital, which is the amount you put in this section. And you can see how this position size, this number, adjusts to the number you put in, right? And actually, as Jonathan was saying, 0.25, that would be, in this case, 12 lots. I mean, 0.12 micro lot, 0.12 a full lot. Also, you can put in the fixed dollar amount. If that is the case, let's say you already agreed on in your trade plan that you want to be risking a certain specific amount in dollar terms, you can put it in here and it will calculate it for you. All right, so the EA has different tabs. I think I will try to go. I'm not going to discuss every one of them because, as you can see, it has many features, and it's going to take a long time if we were to discuss each one of them. But I will just mention the ones that are important. The tab of risk, you can see, as you can see here, risk and reward in dollar terms. You can have an overview. This is especially important if you have multiple trades on, right? If you only trade one, then you probably already know how much the risk is per trade, right? Because that you were supposed to do that in advance. But if you have multiple trades, multiple setups, then this is very useful. Where you can have where it says current portfolio, that is the open trades, and it gives you many metrics on it, right? How much you're risking in percentage terms, what is the lot size, the total volume, and also the reward, also in percentage, and the risk reward ratio between the risk you're taking and the reward you stand to gain if all of them hit your TP. Below here, this is important for traders who trade with pending orders, right? Perhaps you have a couple of trades on which are already open, but you still have limit orders, pending orders in the market which have not activated yet, and you want to know if all of them get activated, what would be the total risk on my account, right? Very important to manage those risks, especially with prop firm accounts, because they have a specific they have limits, right? We all know that max loss limit and daily drawdown limits, right? So it's important, and this will help you include the limit orders as well in your calculation. Similarly, you can have it in percentage, lot size, and the risk reward ratio for all of your trades. That's the one below here, including your pending orders and your open positions. Then you have some other tabs about the margin, which gives you useful information. And the swap, of course, uh, that is especially important if you're trading, you leave the trade open for multiple days. After that, you have also the last tab, which is this. Is you can see there you have many options, and these are very helpful because you can limit the number of trades to be taken at the same time, either on account level, right, regardless of the symbol, or per symbol, right? The other things, you can also put in a max volume per symbol, right? And you might think about, well, when do I use this? Well, this will be able to avoid, let's say you already know from your system that you're going to be taking roughly between 1 and 2 lot size. I mean, the position size of your trades will be between 1 and 2 lots maximum, and you're only going to be taking one trade per any given time, right? So you can, if that is the case, and you're never going to be taking 3, 4 as in the size of the position, you can put in the maximum lot, maximum volume, which will automatically, if the trade is bigger than this, if you're by accident you wanted to enter something 10 times bigger, it will not open it for you, right? Because this will help you, that human error that we mentioned before. All right, so let's continue. We have that. Also, we have different filters that help you manage your risk, making sure that you're not risking more than you should. One last thing I want to mention is you have here the order commentary, which will be able to this when you open a trade with this order commentary, you will find it will print this as the comment on the trade. This will be able to help you identify the trade when you analyze, right? Let's say you have different types of setups being traded at the same time, then this will print it and make it much more easier to identify them afterwards. The magic number is important for if you have a trade management EA, right? For in order for it to identify the trade and manage for you, right? This is very useful. So you can have your magic number, your trade open with a magic number. That was the last thing for once you have everything set up, right? The stop loss, the take profit, and everything set up. I don't have anything right now. This is only for showing how it's used. When you have the trade on and you're agreeing with the position size, you then go to your trading tab and you click on trade, right? If you do that, it will ask me, it will have come up a pop-up dialog window where it will ask you for confirmation. You can review your trade, and if you agree, you click on OK, and it will open it. I will open it very quickly and close it like so. It will open the trade, and as you can see, it already have your stop loss, your TP already in place, and I didn't put in a comment, and that's the trade, right? I'm going to close it because, of course, it's only to show you guys how it works. All right, so that is the position sizer. Very, very useful. I use them every day. I only trade mostly, almost completely through position sizer. And I think there's even edge in it. Yes, edge, because there's very little delay between when you get a signal and you enter the position, right? If you had to put in the stop loss and take profit in manually, and you trade a lower time frame like I do on the 1 minute, there can be some delay, and that delay can be relevant for your account, for your strategy. So I'm going to switch back to the presentation. Let's change this to where I was. And let's get back to it. Let's switch. So tell us in the chat what you think of this presentation, and if you have any other questions regarding what is presented today. There we go. All right, so I will show how you manually calculate your position size to manage your risk, the risk per trade, of course. We show how you do it with a web calculator and the EA, right? This was something I had in case I was unable to show it on the browser. The next subject I want to introduce is the concept of R. If you are, if you've been in the trading industry, if you've been a trader for some time, you probably know this already. But if you're not familiar, then pay attention. In trading, it is best that we think of the profit and the losses in terms of R. What is an R? What do we mean by that? That's the risk unit, right, per trade. That is the amount that you risk per trade, and it's always 1 R. Every trade is risking 1 R. Okay, so you express everything else, the metrics of your performance and the profit, in terms of the risk you've taken for that trade, right? It puts things in perspective, in the right perspective right away. And it makes it much more easier to compare between different strategies and different account sizes, to compare as well between different traders. Because depending on your account size, a certain profit may be a lot, may not be that much, right? And unless you convert everything to R, the comparison between two different strategies will not tell you very much, right? So the concept of R, or R multiples, is to normalize or standardize the performance of a strategy so that you can compare them easily. All right. This is not only for profit and loss, but also intra-trade in the context where you have the trade open. Let's say you are in profit, and it may be $50 in profit, let's say. But that $50 doesn't tell us very much unless we know how much you're risking, right? So instead of thinking $50, it's much better to say, okay, if I was risking $100 and I'm $50 in profit, in our terms, and that's how we should be thinking, it is 0.5 R profit, right? So you express everything through R multiples. This you can do while the trade is open, right? But also at a strategy level, right? You can say, well, this strategy gives me a profit of 5 R per month and a drawdown of 3 R, or whatever it is, right? And comparing different strategy, as I mentioned before, if you have it in R, it's much more easier for that comparison. But also for metrics like expectancy, right? Expectancy is, of course, the net result divided by the number of trades, right? So let's say you've gained in 1 month 10 R, right? Remember, I'm already talking in R, 10 R, and you divide that by the number of trades. Let's say you took 10 trades that month. That means you divide that 10 by 10 and you get 1. So you have an expectancy of 1. What does that mean? It means on average, you're gaining 1 R, 1 risk unit per trade, right? Okay, let's get an example how this R is, how it is important and why we should be using it. Let's say we have strategy number 1, risking $100 per trade, right? So yes, $100 per trade. After 10 trade, this person has a profit of $325. Imagine we have another strategy. risking $25 per trade. And after 10 trades, this strategy has a profit of 125. Right now, I want to ask you, which one made more profit? I'll give you guys a couple of seconds to answer this. Was it strategy number one, which had 325? Was it strategy number two, which has 125? Right? If we just look at the numbers, of course we're going to say it's strategy number one, right? Because it's 325, which is more than 125. However, what is important is, and that's where the importance of using R is, it's the if you have only the dollar amount without knowing how much you're risking, it doesn't tell you anything, right? So in if we convert everything in R in the R multiples, right? Strategy number one has an R of $100. That's the risk unit. That's the amount it's risking per trade, right? So if you convert that 325 profit by divided by 100 to get R, right? That means that 325 is equivalent of 3.25 R, right? So that is the profit. And if you do the same for strategy number two, you have the risk unit being $25, and you divide that 125 by 25, and you get 5R. So in terms of the risk taken per trade, strategy number two is much more profitable. If you ask me, I'll be taking strategy number two any day of the week, of course. It made 5 in the same 10 trades. It made 5R instead of 3.5. So this illustrates why we should be thinking about R all the time in trading and not about the dollar amount. All right. All right, let's take the next slide here. We have, okay, so first thing, I explain how to calculate your lot size, right? Your position sizing, the formula and different ways to do that. But how do you know? Actually, I'll tell this in the following slide. There are different ways to manage your risk going forward. This is also called money management, right? But I like to call it risk management because money management entails other things, as in withdrawal and deposits as well. And risk management, to me, position sizing in time, right? So not one time, but successively in the second and the third and the going in time. How do you manage risk? And there are many different ways to do that. One is, of course, you can risk a fixed amount, right? A fixed dollar amount each trade. There's nothing wrong with it. It's in certain times it is the best way to do it. Let's say if you are unable to calculate it at each time, or if it's a very short period, then it makes sense to do it this way. And let's say you have a 100K account and you want to be risking 1%, and that is, of course, 1% of 100, that will be 1,000. So that's going to be, you're going to be risking 1,000 per trade, right? And since you're doing the fixed amount, you're fixating the dollar amount, right? Meaning that each trade going forward, you're going to be risking 1,000. That's the fixed amount risk way of doing things, right? So that means on the first trade, you're going to be risking 1,000. Regardless if you win or lose, on the second trade, you're still going to be risking 1,000. Okay, that's one way of doing things. A lot of people do this because it's easy. You don't have to calculate anything else. You hear this from many traders. I risk this amount, this dollar amount per trade, which is fine. But we also have a different way of doing things, right? And I believe this other way that I'm going to introduce is much better. And it's called fixed fractional risk, right? In this case, let's say you have a 100K account and you're risking 1%, right, of each trade, which is also $1,000. However, right, you don't fix you don't get fixated on the dollar amount, right? So once you calculate that 1% of 100K is 10,000, as you did in the fixed amount risk above, right? You fixate on 1,000. When you're using the fixed fractional risk, you don't fix the dollar amount. What is fixed is the percentage, right? So the percentage of the risk capital, right? So in this case, you have 100,000 as risk capital. You risk 1%. That means you're going to be risking 1,000. However, right? So the first trade you're risking 1,000. However, if let's say you win the trade, that means that let's say you won 1R, right? I'm already testing you guys if you're how you should be talking about profit. You win 1R, meaning, of course, you won in this case 1,000. That means that your balance or your risk capital increased from 100,000 to 101,000, right? Since the percentage is what is fixed, right? That means that now you have to calculate it again. It's going to be 101, well, 1% of 101,000, meaning that the second trade no longer you'll be risking 1,000, but 1,010, right? You get that? So the percentage is what is fixed, not the dollar amount in fixed fractional risk. This is the optimal way of trading, of risk, managing your risk in terms of position sizing, right? This is far better than fixed amount risk. And I'm going to show you why I think it is the best way. When you have fixed amount risk, what happens is in time, if you have a profitable system, what you will see is that it will grow in a linear way, right? Meaning um, after 10 trades, you will have a certain amount of profit, right? And the next 10 trades, the next batch of 10 trades, you will have this equal amount. Another, the same amount you had on the first 10 will be on the second 10. That is in the case if it's a profitable, and in a losing, unprofitable system, you'll be losing at the same rate going forward in time, right? However, when you have a fixed fractional risk, what happens is you'll be making use of the compound effect of to your trading. So that means that when you are a profitable trader, you will have an exponential growth, right? You'll have that compound interest effect on your profits, meaning at the beginning, let's say on the first 10, once you already have profits after the first 10, that means you'll be taking a bigger size, not necessarily bigger risk, because the percentage is the same, but the dollar amount to be risked is going to grow as you have more risk capital, meaning that your profit, if you have a profitable system, of course, your profit will also grow accordingly. And in the case of an unprofitable system, and this is where the value, I think, the exponential growth, of course, is very important, and of course will help you reach great heights of profits. But for your risk, fixed fractional risk way of doing things is much, much better. Because as you're losing, right, your risk capital also drops. Meaning, since it's a fixed percentage, right, it's a fixed fraction of the risk capital, that means that you will be risking less as you're going deeper into drawdown, right? And in math, you call this an exponential decay, right? So as you go further down in drawdown, you'll be risking less and less and less. And of course, this graph will be approximating -1, right? Which is losing the account. In theory, you never lose the account, right? In practice, you will get to a point where you get to one micro lot and you can't take half of that. So your exponential decay will stop, and you will just at a certain moment eventually lose the account. However, it will take you a lot longer compared to a fixed dollar amount, right? And remember what we said about at the beginning. You need to prioritize the survival of the account. As a trader, you need to be a risk manager, and this, right, helps you extend the longevity of your account, right, by risking less when you are in drawdown, and when you are profitable in periods when you're profitable. This way, using a fixed fractional risk in position sizing will give you, allow you to risk more automatically. You don't have to do anything, right? So you earn your right to risk more. All right, so let's compare these two in one graph so you have an idea. The red line is the exponential growth of a fixed fractional risk compared to the linear growth of fixed amount risk. As you can see, if you start risking the same amount, and one trader is using fixed amount compared to fixed fractional risk, you will see that in time, right, keeping the same strategy, that is same strategy, exactly the same, the fixed fractional risk in time will have a higher profit compared to a fixed amount risk, right? And in the case of a unprofitable system, right, the same system traded by different way of doing your risk management strategy, the fixed amount risk will reach -1 much earlier than the fixed fraction, what we just talked. So the the trader who uses fixed amount risk will reach that max loss limit of the account much earlier, much faster than someone that is using a fixed fractional risk, and is risking less as that person is going into drawdown. This is important because in trading, right, when you're learning to trade, you are in essence, you are in a race against time, right? A time and resources, right? Because what we need to be doing, right, as a trader that is learning to trade and become profitable, you need to reach profitability before you run out of time and resources, right? And this way of doing position sizing, fixed fractional risk, allows you that your account will last longer, right? Your system will have less drawdown, and thus it will avoid or minimize the risk of ruin for you. So it's very, very important. I think this is the best way to handle your position sizing, to manage your risk um, in time, through time. All right. So another thing that the next subject that I would like to talk about is the available risk capital. I believe this is not talked about enough. Um, when we when we think about it, the available risk capital is, well, let's say the prop firm account. Let's say you have a 100K account from the 5ers, high stakes. That account has a max loss of 10%, right? If that is the case, how much capital is actually available to you, right? It's a 100K account, but do you really have that 100K at your disposal? Can you really use that? You can use it for leverage, but you can't use it for your drawdown. So it's not really available, right? So the the available risk capital depends on the settings or the risk tolerance of the account. The account that I just mentioned has a risk tolerance of 10% or 10K, right? If it is a personal account, you decide what the risk tolerance will be, right? Whether you want to be risking 10K, 10% of that account, 20K, 50%, or the whole account, right? You decide that. But with a prop firm, the rules are set. There's nothing, there's no choice there. It's already set. So it's fixed. You have to know this in advance, of course, and we know this, of course, but that available risk capital is not the balance, right? So let's compare the high stake account with the bootcamp account, and this will illustrate why we should not be focusing on the balance. We should be focusing on the available risk capital always, right? If in the case of the high stake, let's compare the high stakes and the bootcamp account, both of them a 100K balance, right? The high stake account, as I just mentioned, has a 10% max loss on the account. If you lose more than 10%, you lose the account. So that's the available risk capital. That, of course, computes to 10K, $10,000. On the bootcamp account, it's 5%, right? Both of these are step one of the account evaluation, because with the funded with the bootcamp account is of course 4%, but both of them for this comparison is step one, what I'm comparing here. On the bootcamp, the max loss is 5%, right? That calculates to be $5,000. As you can see, you have two different accounts. They have the same balance, yet the available risk capital is completely different. So why do we focus on the balance? We should not be focusing on the balance, right? Using the available risk capital is far superior than using the balance for position sizing. You should not be using the balance. You should be looking at the available risk capital. And I have another example that will illustrate what happens, what is the difference. Assume a trader is risking 1% of the initial balance, right? 100K, that of course is $1,000. The max loss on the account is 10%. We're continuing with the same percent, with the same example of the high stake account. That means that the available risk capital is 10,000, right? So the actual risk, right, is 1,000 divided by 10,000. That trader is risking really 10% of the available risk capital, right? Because that's the relevant metric here, not the balance. It's the available risk capital, right? So if you think about it, then that 1% didn't sound like a lot, but 10%, man, that's a different story, right? So after 5 losses, his balance would be, let's say he's using a fixed amount, right? After 5 losses, his balance would be 95, because of course he lost 5 times 1,000, that would be 5,000. He started with 100 minus 5, that would be 95,000. All right. After 5 losses, he's at 95 balance, right? If he continued to be using 1% of the initial balance, that would mean that he would be risking 1,000 still, but he only has 5,000 available risk capital, meaning he's risking not 10% of the available risk capital, but 20%. He didn't do anything. He's still risking. He's thinking, I'm risking the same. I'm risking 1,000. It's the same risk. No, sir. He actually doubled the risk he's taking. He's risking now 20% of the available risk capital. As you can see, using a fixed amount, dollar amount, isn't that great. It's much better to use available risk capital, right? Now we get to the next part. I explained that fixed fractional risk is superior, is much better than a fixed amount. Fine. And I explain how to calculate the position size once you have the percentage that you want to be risking. But now comes the question, and maybe the most important question: what percentage should I risk? Right? In the YouTube live stream, we get this question, and on Discord as well, we get this question all the time. How much should I risk? I have this account, I'm using this, that. How much should I be risking per trade? Well, the amount you risk depends on your measured historical maximum drawdown. Okay? And this is, of course, different for each strategy. That is why the answer always is it depends on your strategy, right? If a strategy has data that tells us that it goes to a deep drawdown, then you should be, of course, risking less. If it is a very stable strategy that doesn't have a deep drawdown, of course, you need to you're allowed, you're able to risk more on it. So it depends on your drawdown, your max drawdown that you've measured in the past in your data, and this will help you decide how much to risk. So how do you measure the historical max drawdown? It may sound easy, but I think it's still good that we go through it, right? So the first thing you do is you convert your P&L into R, if you haven't done so already. Then you calculate the cumulative P&L in R, right? I will show you how this is done. Then you plot your equity curve also in R. You do everything in R. And then you measure, you identify, and then measure the drawdowns in equity from peak to trough. Okay? How is this done? Let's say you can do it manually, but you can also do it in Excel, let's say, or any spreadsheet. Let's say very simply, without putting any more information, you have the trades on, or you say trade one, and you have the P&L, right? Let's say you're risking 50R and it hits stop loss. And then you have to have all your data, of course, right? The first step is you convert everything into R, right? So if you're risking 50 and the results of the result of the trade was minus 500, and you're risking 500, that means you lost minus 1R, right? So you calculate the result by dividing it by the risk you took on that trade to get to that amount. You calculate, or you convert the P&L in dollar amount into R. The next step is then you do the equity curve, which is you keep track the cumulative P&L, right? So you start at 0 and you add, after the first trade, you add the result of that trade, which is minus 1, right? After the next trade, if you lost again, of course, it will be minus 2. So you keep track of the equity curve after each trade, and you have this column in the end. This is the equity curve. And after that, you take the equity curve and you plot it in a graph, right? And you will have something like this, right? This corresponds to the data I just presented, right? So it starts at 0 and it went into drawdown before it started getting some profits. So after you have the equity curve, you identify the peaks and the troughs, right? And then what you're looking for is the max drawdown, of course. So the max distance from peak to following trough, okay? Once you have identified which one is the biggest, you measure this. And you can look this up, of course, in your data, because the peak in this case is at 19, I think this is, yes. Or is it 20, 19? And then you measure when, on the axis, you can read what trade it reached the trough, and that would be, you can read it, the difference between those two in your data, right? This information is key to knowing how much to risk. Because if you think about it, what is the risk of a trade, right? The risk of a trade is the distance from the entry to the stop loss, right? Very simple. What is now the risk of a strategy? On a strategy level, the risk is, of course, the maximum drawdown. So you have to know your maximum drawdown so you know what the risk is of the strategy so that you can adapt your position sizing accordingly, right? So after you have that, so how do you know how much to risk? It's this formula. Your risk unit, how much to be risk per trade, is the available risk capital, not your balance, your available risk capital, which depends on each account depending on the rules of the prop firm or if it's a personal, your available risk capital divided by the historical maximum drawdown. And you see here, I have multiplied by a margin for error. And the reason for that is that if you measure your historical max drawdown, let's say you do your back testing, you did it over 6 months, and you measured a maximum drawdown. However, this measured historical max drawdown, right, only tells you something of those 6 months. Of course, you can use it to get an idea what the future max drawdown will be. But as you can think, as you can assume or suspect, in the future, you may or may not have a bigger, right? A bigger max drawdown. The fact that you measured a certain max drawdown in the past doesn't guarantee that you will not have a bigger max drawdown in the future. So you have to take a margin for error. This is personal. How much you take is personal, but you have to account for that difference, right? So what you're actually looking for is the assumed future max drawdown. You don't know this, but you have to assume something based on your back testing, based on perhaps you even have forward testing. Based on your data, you need to assume what the maximum drawdown that you will be incurring in the future. And you use your historical max drawdown adjusted with a margin for error, a factor. I like to use 2, right? So I take my historical max drawdown, I multiply it by 2, and that's going to be, I assume that in the future, it will be maximum twice the historical max drawdown that I measured. Whether it's going to exceed that or not is difficult because that's, of course, is the future. We don't know that. But it's safe. It's a safe way if you at least do 2, because then you're allowing yourself a lot margin for error. All right, so that's what I just mentioned. The measured maximum drawdown is an approximation of future max drawdown. We don't have it yet, the future max drawdown, because it's in the future, and that's why we need to use a margin for error. So let's say in an example. So how do you use this, right? Let's say you have available risk capital of 5,000, right? You have measured in the past, right, using the steps that I just shown, that, and I hope that you're using a large enough sample size, meaning not just 10 trades or 20 trades, but you actually have a good number, at least 50, but preferably something in the hundreds if possible. You measure your max drawdown. Let's say you measure that in that data set you've measured that the deepest drawdown was minus 5R, right? Very nice strategy, by the way, if that's the case. That's not a lot. Let's assume that you're taking a margin for error of factor 2. That means that your assumed future max drawdown is, of course, twice the measured, which is 2 by minus 5 is minus 10. So you assume that in the future, your strategy will not have a deeper max drawdown than 10%, than 10R. Okay? And if you place the formula again. So how do you know how to risk? How do you calculate that? That's the available risk, of course, divided by the measured risk with a margin for error. And if we input all of that, it will be 5,000, of course, divided by 10R. When you do this, you have to solve for R, which in this case, of course, that means that 1R is 500. Okay, this is the way to do it based on your data, based on your measurement of the drawdown. That is the way to do it. Not because everyone else is risking 1% or 0.5% or 0.1%, it's going to be adequate for you. No, you don't know that. Unless you know your measured maximum drawdown, you're really going blindly at it, right? This way, even though it doesn't predict the future, you may have a higher max drawdown in the future, at least your position size is based, the risk you're taking per trade is based on the data that you measured in the past, right? As long as you trade consistently the same way in the future, you should have the same kind of results, more or less. Okay, this way you're going to be gonna know in advance what can be expected. All right, so let's another example. We have 100K initial balance. Let's say the max loss limit on the account is 5%. That means that the available risk capital is 5K, right? This could be a bootcamp account, for example. The assumed future max would be minus 10R, right? And in this case, as we just seen, the risk per trade is 500. And if you think that 500, what is it compared to the available risk capital? You can see that it's 10% of the available risk capital, right? You see that? The available risk capital being 5,000, and the risk unit, or the risk you're taking per trade, is 500. So that's 10% of the available risk capital. What happens? After one trade, you have a loss of course, minus 1R or minus R. Your available risk capital after that trade is no longer 5,000, right? Because 1R, as we've seen in the previous slide, is 500. So if you lost 1R, minus 1R, that means that you lost 500. That means that your risk capital drops from 5,000 to 4,500, okay? And since you're risking 10% of available risk capital, right? That's the fixed fractional risk. It's not fixed on the dollar amount, but the fraction, 10%, the fraction of the available risk capital is what fixed. That means that you're going to be risking in the next trade 10% again of the available risk capital, which is 4,500, meaning that it's $450. Here you can see that as you lose, you'll be risking less, right? Previously, you started with 500, and now you're risking 450. On the next trade, let's say you have a win of 3R, right? Now, the available risk capital, of course, has changed, because now, since you were risking on the second trade $450 per trade, or per that trade, and you won 3 times the risk you assumed, right? Means that it's 3 times $450, right? Was added to your risk capital, right? So your available risk capital is those 4,500 plus 3 times the $450, which comes to 5,850, right? So as you can see, and now you will be risking 10 on the next trade. On the third trade, you'll be risking 10% of that available risk capital, which is of course 585. As you can see, you earn the right to trade bigger lot size and bigger risk, right? You have to earn it. It's not something you just level up because you feel like it. No, you let your strategy, your performance allow you to trade bigger automatically using fixed fractional risk, right? So one disadvantage of this way is that you need to calculate after each trade. If you're taking one trade a day, then that's not a big deal. If you're taking multiple trades each day, then perhaps you may have to do it after each day, right? So that it doesn't uh, cause you a lot of delays in your trading, especially if you're on the 1 minute scalping, let's say. Then this is not very practical, right? To be changing the amount to be risk. So what you can do is use a combination of them too, right? So you use a fixed dollar amount during the day, but at the end, the next day, you apply the fixed fractional risk, meaning that you're doing only the calculation one time, which is what I do. At the beginning of the day, I calculate what is the amount to be risk based on the fixed fractional risk way of doing it, right? So that is my presentation for today. I believe if you grasp these concepts in risk management, right? Think about available risk capital, using fixed fractional risk, and apply them to your trading. To your trading, you will be a much more equipped risk manager than otherwise. That's uh, that's my presentation. Are there any questions on risk management?
Well, this was amazing, Victor. Really, really good webinar and good presentation. And like you said, it's just super, super important stuff, this right here. So guys, if you do have any questions on anything that Victor have covered here today for us, please let us know in the comments. And we do have, it did actually take 1.5 hours. So that's perfect. So we do have some time to actually go through the markets here. So what I want to do is just want to pull up TradingView here, and then while doing that, we can see if we perhaps have any questions in the comments when looking at the markets here. We did have one question. What about doing 1% risk of available risk capital? I mean, yeah, if your system is up for it, then 1% per trade works, but that's a lot. Okay, 1% per trade is huge. You need
Well,
need a
yeah.
very high win rate.
Well, if your risk
Oh, he's
capital,
talking about available risk capital. That's, of course,
yeah, yeah.
that's something different. I'm thinking balance.
Yeah, yeah. 1% of balance. We hear this a lot in trading books, investing, and so on. The most common, what people say, is between 1 and 2% of your balance. That is okay if you have the whole balance. If the whole balance is the available risk capital, right? So
Yeah,
if it's on your personal account, then if it goes to 10, 15, 20% drawdown, it's not comfortable, but nothing will happen. And if that is the maximum, then yes, you can perhaps withstand that. But in a prop firm, you can't think like that. And that's why I mentioned the available risk capital is so important. Because if you apply what I just said to your prop firm account, you probably lose your account before you know it, right? So you
yeah.
have to think about the available risk capital. And 1% of the available risk capital, now we're talking good risk management. 1% is good. 1% is good. And if you think about it, that's going to be 0.1% of the balance, which is very better, much more conservative than 1% of the balance, which is 10% of the available risk capital, right? We have to, when you think about, as I said, when you think about risk management on a prop firm settings, you have to think about the available risk capital. Everything you do, you need to be based on that, because that is what you have. You don't have 100K, you have 10,000 to play with. You can, if you go over that, it's game over, right? We can't have that. So 1% is great. I think that that user is on the spot with it. You can, but of course, it doesn't have to be a fixed number. What we need to do is, of course, measure your maximum drawdown in the past, and based your size, the risk you're going to be taking, the percentage on that data, right? We need to be using data for our decision, evidence-based trading, I would like to call it, right?
Yeah. No, you're absolutely right about that. And again, guys, like I said in the beginning, this is a super important presentation, and I do recommend that you rewatch it, because if you do get this right, then that is your key of staying in the game long enough to perhaps become profitable. If you're just on the edge right now of profitability, the thing a lot of people do is they, as Mark Douglas says in the book Trading in the Zone, he sees that most traders in the market are these goes through this boom and bust cycles, where they they trade very well for a couple of weeks or maybe a couple of months, and then in a fairly short amount of time they give it all back, and then they do it all over again. And a lot of times you see that when you do give it all back, you start revenge trading, or you start over trading, and you start over risking. And that's a lot of times when you'll lose the account. If you're able to fix risk management, you'll eventually come to the point where the drawdowns won't be as deep, and then the pushes to the upside will be you'll create higher highs and higher lows basically on that equity curve. And it has a lot to do with risk management, because if you have a very good risk management, over trading and revenge trading will not hurt you as much as over risking. That's really the biggest problem, is over risking, in my opinion. We have a comment here saying, and like I mentioned previously in the webinar, if it says awaiting moderation, that means that you've uploaded everything correctly, so there's no issues on that. Let's see if we and guys, like, probably this is probably one of the most advanced risk management webinars that you'll see on YouTube. But if you go to YouTube and you Google risk management strategies, you will not get anything like this. Like Victor says, a lot of times you'll get advice that says, oh, you should be risking 1 to 2% of your account. Well, if you're risking 2% of your account, then the account is gone in three trades. If you're on like the hyper growth program, which has a 6% stop loss, and you're out in 3 trades in a row, then you're out. So so I don't really understand that whole idea when we talk about evaluation accounts and profit from trading. How could anyone be profitable long term and risk 2% per trade when all you need from starting balance is 3 losses in a row and you're out? It sounds good in theory, because 1 to 2% is nothing. And on a personal account, again, if you have a 10K personal account and your stop loss is basically 0, which means 100%, then that, of course, creates a whole different situation. But we're not trading our personal accounts here, right? We're trading funded prop firm accounts. So these risk management strategies that we're talking about here will not only work for your personal account, but it's almost necessary if you want to make it long term with a funded firm, or a funded account at a prop firm like ours, the 5ers. And if
There's another
you
thing. Go ahead.
no, go ahead, Victor.
There's another thing that I didn't go into the presentation, because, of course, risk management is quite broad topic. We can talk, many days about this. I only picked a couple of things that I think are the most useful for traders trading, any prop firm. But there's another level, another depth to this. What you can do, I didn't mention this, as I said, what you can do is when you measure your historical max drawdown, that is only one equity curve, right? And I use a huge margin for error, which is twice. But what you can do is you can have multiple equity curve based on your data, based on your win rate, your risk reward ratio, and you could put that into a Monte Carlo simulation and go like 10,000 equity curves, and then you get, what are the extremes possible between in between a certain certainty confidence level, and base your position size on those data. I didn't go into those details. It is much more, refined and sophisticated. You don't have to do that necessarily. With this, what I just gave you is good enough to uh, you know apply proper risk management. You don't have to go much deeper, although it is possible to do so. To us, as traders, as retail traders, you have to think strategically in your resources, right? So if you're going to spend hours and hours on end to calculate your position size, it may not be the most optimal way to do it at, right? And this way I just mentioned, you do have to have your data, because if you have to base everything you do on your data, the data is king, right? So you have to base it on data. But once you would have to have the data anyways, right? You shouldn't be trading if you don't have the data, right? So you should have the data already, and you just convert it to R and do the following steps, the steps that I mentioned. And so you based on the data, it shouldn't cost you that much time. Yeah, that's what I wanted to mention.
Yeah. Okay. So let's see if we have any more questions here. But we do have the U.S. elections today. I wonder when is the actual, like, when do we know who's the president?
I think it takes many hours, right? It's around midnight U.S. Eastern time. They start getting those projections that get more and more certain with time. For European time zone, that's going to be the early hours of the morning, of course.
Right.
So
It's going to be around morning of November the 6th, right? Like 3 or
yeah,
4, something like that, right? Yeah. So that's when we
when they
know.
have
So
when they have some numbers, some preliminary numbers from the exit polls, not the exit polls, I mean the actual vote counts.
yeah.
So you will have the exit polls you'll have during the days already, and that will give you an idea of what kind of results you can expect. But when the actual vote counts get in, when you have like 50-60% of the counts already in, you already get a good idea of who's going to be the winner, and that's going to happen around, I think, midnight Eastern time, something around that time.
So I did some. I've done some research and looked at different polls and interesting. You know what? Let's ask this. Let's ask this. Answer this question. So the assignment. Today's assignment is every trade that you take on the demo account from today going forward is going to be 0.25% of your account. Okay, so 0.25% of your balance. The idea of this assignment is that you're going to take 2 trades per day with 0.25% risk of your account balance, of a total of 8 trades from today to Friday, 2 trades a day. Now, the idea is that we don't care if it's a winning, if it's winning trades or losing trades or whatever. What we care about is making sure that you know how to calculate position size. Now, a very good way of doing this is using the position size calculator or MetaTrader from that Earn Forex website, which is available on the event page. You will have a description of the assignment where you also have a link to download that. That, in my opinion, is the most effective way of calculating. Yes, that's the word, I believe. Calculating your position size. Very good tool to use. I use it, and Victor does use it as well. So that is the and if you're taking a trade yesterday, doesn't matter. Doesn't matter. It's from when this live stream started or from now going forward.
Yes, we have one question here in the audience to how to check the commission inside the MT5. You can rewatch the live stream, of course, on YouTube, where I explained that. But it is in the market, the market section. You right click on the pair, and that will you have to choose specification. The market watch. You have to open an MT5 market watch by Control M, letter M, and then it pops up. You right click on the pair you want to know the commission from, and then it will have a drop down or a menu will pop up, and you click specification. There you'll have to scroll down and find the commission and all the other relevant information of that pair.
So, Victor, what's now? I don't care who you would vote for. I'm only interested in hearing who do you think will win? Who do you think will win today or tonight?
I have no idea, to be honest. I have no idea. I have
it
no
seems
idea.
to be a very close one. It seems like a very close one.
This is a bit of a different election, because normally when you have the second term of a president, they typically have a better chance of winning, right? But this isn't the case, because it's going to be Democrats are already in power, but it's going to be a different president, so you can apply that statistics to it. And Trump is very popular. I don't know. Many people are really supporting him, so it's difficult to say. I think it's a very difficult call here.
The feeling I'm getting is that Trump is probably going to win. That's the feeling I'm getting. I've done some research, and of course, as a trader, we're not even in America, so we have no we honestly we can't vote. We don't really, even if we do care, we're not in America, so it doesn't really matter. What I care about though is how can I set up different plans for whatever outcome is coming. Now, of course, the simplest way is just ignore fundamentals. Just ignore fundamentals and wait for the noise to settle and then trade price. Okay, because everything's in price. And that's what's interesting right now, because what we're seeing right now is, of course, we see right here, Bitcoin is moving to the upside. And like I said, I believe in the middle of this live stream, I posted this on Twitter as well, said that if you are looking for Bitcoin to perhaps reach new all-time highs from the outcome of this election, then this break and retest that we got here yesterday, and we're moving out of this level right now, it looks like a very, very good level for possible entry on Bitcoin. So what I'm seeing here, and this is what I'm thinking, right? If Trump wins, we are going to see weakness in the US dollar, because people, I believe, is going to move into risk assets, because I do believe that the market is currently pricing in a Trump victory. I did some research as well, looking at many different polls, and it does seem like Trump is leading in the polls. Now, I don't care who wins, right? But that's what I'm seeing. And if we look at that perspective, that people might believe that Trump is better with business and it would be a better environment for risk asset, then we're seeing Bitcoin is moving to the upside. We are seeing the Australian dollar versus the US dollar moving quite aggressively to the upside right now, with a very solid breakup structure. And it looks like we have a low of a move that got initiated, 1 month ago. So it's a major reversal. It's a major shift of structure here on AUD USD. And looking at Euro USD, it looks like we're seeing the same shift right here, coming down into high time frame level, breaking a very clear structure. And if this is the case, that there's going to be possible USD weakness with Trump, then I do see that the market is potentially pricing in a Trump victory. Remember what happened, I believe, yesterday or perhaps the day before, where Kamala reached a point where she gained a clear advantage in, I believe it was Iowa, which historically have been voting for Republicans. That caused a dip in EURUSD, ADUSD, and as well as Bitcoin. So what I'm seeing now is that Trump perhaps is gaining in the polls, and that brings on risk. So truly, the meme that is the Trump pump might actually be true. And what we're seeing here is potentially the very beginning of that. Now, well, of course, we don't know long term. I do, however, think that whoever wins, long equities, the indices, the equity indices, they're going to go up. I mean, they're going to go up. If you look at S&P 500, you go out to the weekly. I mean, yeah, does it really matter who's the president of the United States? It doesn't look like it matters that much. I think what matters more is the overall economics and the overall macroeconomics of the global situation, right? But we do see some very, very interesting movements today. I mean, we've all talked about this move down on the EU. It's been a very difficult trading condition for the last month, and maybe that difficult trading condition is the answer to that is within this move. That's what I'm thinking. And now that we're seeing that break of structure and potentially EU coming back into a bullish trending market, maybe we'll see a more stabilized trading environment going forward after the US election. So what I'm seeing on EU here is if Trump wins, we're probably going to see a move up to $1.1. I do believe that Bitcoin is probably going to break into new all-time highs this week or next week, depending on the outcome of this election. And we also have pairs like ADUSD potentially reaching the 0.66 level right there. So that's my, I guess, predictions. And then if Kamala wins, I don't know. Like that's a tough one because we really do not have any ideas of what's going to happen if Kamala gets elected. I know Trump
Yeah,
has
I
been
think,
president already.
yeah. It's going to be fun, and I think as traders, you want these events to happen. Although you need to be careful with the volatility, but there's opportunity here because if it surprises the market, you will have movements, big movements, and these big movements will cause or allow you to have will offer you opportunities, right? Things will be mispriced, and you can get a good price on things, to say to put it in a way.
We're getting some questions about what the simulation you talked about, and that simulation is the Monte Carlo simulation, which you can just Google Monte Carlo. You can look it up. It's also, I believe, available within Edgewonk if you have that as well. But just do a quick Google of the Monte Carlo simulation, and you're going to get that. And that's actually pretty cool because you can then simulate the the relationship between win rate and risk to reward and your average loser and average loss and things like that, depending on what specific simulation you're looking at. But it's going to give you run a simulation and give you many different probable outcomes of that strategy, which is a good way of looking at your max consecutive losses, for example. I remember doing that simulation and seeing that my strategy, my swing trading strategy, could in theory have like 12 consecutive losses in a row, and that was like eye-opening. Imagine risking 2% on that.
Yeah, yeah. Monte Carlo, what it does is when you think about it, your back testing data is just one set of data, one period where your strategy was performing, and of course, we can use that to have an idea what we can expect in the future, but it's, conditions can change. And if you use the statistics, the parameters of your, the metrics of your strategy, the risk reward, your average risk reward, your win rate, and you apply them, you input them in the Monte Carlo simulation, it will give you all the possible possibilities, uh, outcomes, I should say, possible outcomes. Let's say they typically put it at 10,000, and you will have, given the same strategy, the same statistics, you will have 10,000 different outcomes, and you can place yourself, your risk parameters, based them on them much more precisely. And in that case, you wouldn't have to use a margin for error, which I am using here to make things more simple for everyone. But you can just use something that is completely adequate, fully based on the data, and that is the, you know what is the variance possible in time. But it's not necessary, but it is very useful if you do know how to use it. You can, there are calculators online as well, where you can, play along with it, and for free. So it's very accessible for everyone. You do have to read a little bit to understand what it is and how to use it, but once you get it, it's very useful as well.
That's right. You know what? We've had a very long session here today, and I know that we've also had almost 5 hours, I believe, of my course before this one. So I think we're not going to do the full 2 hours today. We're going to let people have some rest as well. Tomorrow we have very exciting day. We got the market psychology and the behavioral biases from Jordan from Tradelicious, and the market wake up live stream. By the way, I'm looking at that one almost every morning. Really, really good. If you want to get a good, good overview of the markets, good, ideas on fundamental analysis, definitely check that out. I believe it's the market update with Jordan, which is also the head of Tradelicious. And then after that, we're going to have the live back testing and forward testing with Michael, the CEO of Trade the Pool. So very exciting day tomorrow as well. So make sure that you check that one. And then on Thursday, me and Victor is going to be back for a trading panel discussion with Saul, the CEO of The5ers. And we're going to be talking about how we implement all of the things that we talked about throughout the week. So yeah, we're just getting started. We got a lot of content coming up for you guys this week.
Yes, before we wrap up, I would like to offer the audience some insight or some opportunities that I see in the market. Of course, we know this is EU. Of course, we know this reversal is very promising. It has done it at a place very relevant on the daily and on the weekly time frame. There is that weekly order block that it hasn't invalidated yet. It bounced from it, so it has multiple time frames alignment, would makes it a very great trade, right? I would be waiting for price to come back much lower to get an entry here going long. However, as we always should be considering both sides of the opportunities of the market participants, buyers and sellers, there is a little opportunity here that I see, which is the H4, right? We are currently in a daily order block, right? And this is the sell opportunity. I have to mention though, today is election day, of course, in the USA. So it's a good idea to stay away from the market, or if you do trade, do it with perhaps a smaller size, or be very aware not to hold this through the whole day. Keep it short. But what I do see is that there is an order block on the daily, right, which is right here, and we do have the H4, right, which left a order block here and came back within a single digit number of bars since its creation. And if we go, so we have the daily, the H4 in alignment for a sell as well. If we go to the H2, I don't see anything. But if you go to the H1, I can see there is a quasi here. We can identify that like so, right? We have an established uptrend, and then the break of the neckline, and price is coming back, and guess what? Reacting on that order block which left on the relevant time frame. This is the H1 quasi. So the entry order block on the H1 is the one that you need to be watching for. So this area is, and I'm going to, let me get this tool out. I'm going to be watching price on the lower time frame, how it handles this area, this order block, right, on the lower time frame. So this is the area if we are going to have a reversal. If, I don't say we are, but if, then that area seems to me like a great area where the sellers can come back, because that was the structure that they left when in the past when they took control. So if I were to go here and I'm looking at this, and it's not a coincidence that price, has this reaction in this area, because that's the order block I just mentioned. So to the degree that this hold, I don't see a reversal here yet on the H5, right? The neckline is all the way down here, basically. So there's no reversal on the lower time frames, and I have to wait for that reversal to happen before I get in. On the 5 minutes, on the 3 minutes, I don't have a reversal either, and on the 1 minute, I do have a reversal here, which is a quasi. This is the neckline, right? It's only on the 5 minute, on the 1 minute, sorry. So this is the left shoulder. Let me double check that. This high is 11 and this is 11.2. So yes, that is the left shoulder to me. And right, the left shoulder, it's only by a pipette, but it is still the left shoulder. This is why I use quasi. They don't look like head and shoulders all the time. It breaks the neckline, and what I'm looking for is these order blocks that are left behind, right? I want to see how price reacts to them, and depending on that, I would enter the trade short in this case. I know the higher time frames, as I said, are looking very promising for much higher prices in coming sessions, but this could be a day trade and trade for a couple of well, not a couple of minutes, but maybe an hour, maybe 2 hours. And that would be the entry order block on the 1 minute. And since we have overlap, yes, we do have overlap, I'm going to drag it all the way down here. So that would be the entry order block. I would be looking for this area to see if the sellers can come in at this area after it taps into it. And if it does, then maybe that can be a sell opportunity on the 1 minute, and maybe later on a different time frame. And doing so, the first area you could be targeting, of course, is that immediate swing low, right? That was going to be tested. That could be your TP, depending on the kind of trade you took. And other than that, I would be, I could even actually on the 1 hour, I would be targeting perhaps this area. So before this consolidation, I would be targeting that. That could give you, let's say you get in around here. After it, respected that, and you target that TP right there, that's going to give you around 2.5 reward for your risk, which is a nice trade for a day trade, a couple of maybe an hour, maybe two, something like that. That's the opportunity I see in the market right now. So it's going to be fun.
All right, guys.
Today.
So that's it for today's live stream and today's webinar. I would like to thank you all for joining, and a special thanks to Victor for taking the time and really doing this. I know that you've put a lot of work into this webinar, so I really do appreciate that, and I think everyone also appreciates that as well. All right, guys. Hope to that I'm gonna be watching the live stream tomorrow with Michael. Hope you're gonna be joining that one as well. Make sure that you sign up. Make sure that you go to the event page. That live stream will not be on this YouTube channel. You'll have to go to the Bootcamp Trading Week live event page that you get in your email when you sign up for the event, and there's still time to sign up, so make sure that you check the link in the description. Thank you, everyone, and see you guys on Thursday.
Yes, I would like to thank everyone for paying attention today, and I'd like to a special thank you to, the team, the 5ers, for offering me this opportunity. I am grateful because this is my passion. I like sharing, everything I can to help traders succeed in this business. So for everyone, please watch it again if you want to grasp the concepts fully, because they can really be game changer for you. They can make the difference between making it or not. So on that note, thank you all, and see you guys soon. Bye bye.
See you and take care. Bye.
Hi guys, so thank you very much for watching the video. Now make sure you like and subscribe, and most of all, go into the YouTube and check our other content that we provide here at The 5ers. We'll see you in the next one.